Okay, so I was so excited this morning, ahead of the day and ahead of what these guys had to say that I forgot a bit of housekeeping. So this is the book, the encyclopedia. That's for politically correct reasons. Let's not call it the Bible or anything like that. But it's basically available from about 12 over there, right? Secondly, shuttles leave at 1:30. So in the interest of getting it all through, so I had to insist on the strict timekeeping. Sorry, Niels, I'm sure we could have listened to you much longer. Next, it's my pleasure to announce Srini. Now, Srini joined us 1.5 years ago, so compared to Dirk and Adele, he is like a veteran of this business. T-Mobile, hard act to follow, right? But not for Srini. So, Srini, stage is yours.
Right. Thanks, Hannes. So no pressure then. Right. Before I start, just a couple of points I'd like to make. Look, quite often, Europe is a bit hard to understand as a portfolio. There's 11 countries. Each of them is kind of individually small. Yet when you put it all together, it's close to 4 billion in EBITDA. One of the things I want to try and do today is give you some transparency into the portfolio, how I think about it, and really what the future of that portfolio looks like. The second thing is I often read the European business being referred to as the rump European assets. One of my objectives today is to convince you and get you to my point of view on why I don't think it's a rump, but it's actually quite a prime cut. So with that in mind, let me kick into a brief summary of the story on Europe, and then I'll talk about each of it in more detail. The thing about the European portfolio is structurally, it's an incredibly sound portfolio. It's largely converged. It's got really good assets. And I think the paradox of Europe is a group of strong assets have underperformed financially. No question about that. And I'll come back and talk about what's driven that underperformance. Some of it is internal, some of it is external, but we'll spend some time on that. So you've got a strong portfolio, which certainly over the last 18 to 24 months, you can begin seeing signs of a turnaround. You can begin seeing some real strength and the portfolio beginning to perform in line with the inherent strategic strength that it has. As we look forward, I strongly believe that you will see the prime cut emerge instead of the rump, because what we've got in place is a clear plan to take the strong portfolio forward by driving convergence, turbocharging convergence with aggressive fiber build-out, and I'll talk about why the economics in Europe are different from more developed countries, and pulling that all together with a really differentiated experience. On the business side, we again have an advantaged position that we can build on in a world of greater digitization and IoT. And on the cost side, this is one of the places where in the last 4 years we've been very disciplined, and you'll see going forward, there is still substantial potential to drive costs down in this business. So when you put that all together, you get a financial outlook which is a growing business. The amusing thing is one of the first and one of the few German words I learned is one that's Tim's favorite. It's called Wachstum, which I've learned with time means growth. So I think the story I'm about to tell you is a story of how the European portfolio really starts punching in line with its strategic soundness and creates real Wachstum for Deutsche Telekom. So before I jump into the plans for the future, let me start with a quick recap of the last 4 years. Look, bottom line, our financial performance has been disappointing. Across pretty much every metric, we've seen a decline. I'll come back and talk a bit more about what's driven that. But from a portfolio and inherent asset quality perspective, we have seen strengthening in some significant areas. Claudia talked about it yesterday. Tim talked about it. We are now network leaders in 9 out of our 11 markets in mobile. We have pushed forward on our fixed investment, not to the extent that we had hoped for, but most of that was because of regulatory delays and vectoring in some of our markets. But we have pushed forward on our fixed portfolio. And in terms of customer experience, and importantly in terms of diversifying into areas that provide more sustained growth like TV and B2B, we have seen significant progress. And I'll come back and spend a bit of time on TV and B2B in specific. So a mixed bag, but a continuation of the tale of a strategically sound portfolio, not really translating into sustained earnings growth and actually declining in terms of its financial indicators. Now, before I talk about the story in more detail, let me spend a few minutes just giving you the transparency I promised on the portfolio. And a lot of this, when I joined 18 months ago, I think I spent about 4 days in Germany in my first 3 months. I spent my first 3 months traveling extensively across my geographies to get a real understanding of what this portfolio was like, actually talking and meeting sales agents and call center folks to get a really deep understanding of what this portfolio is like. And let me talk you through some of the things that I learned, which gives you a greater degree of transparency into this portfolio. So if you look at this portfolio, it covers 115 million people in economies that are growing at between 2 to 3%. And our assets are converged leaders, which are our big converged assets, where on average we have 55% market share in fixed and 45% share in mobile. That's actually almost 70% of our EBITDA. And when we close out the deal in Austria, it'll actually look like more like 75-77% of our EBITDA will come from strongly converged assets. And in our non-traditionally converged assets, actually by end of June, July this year, we will have access to convergence in all those markets as well. Largely through whole buy, mixture of whole buy and own build. I'll come back and talk about that in more detail. But essentially, we will be converged in all our markets, with the exception of Albania. And more than 3/4 of our earnings will come from markets where we are converged leaders. Structurally, and I'll talk a lot more about this in terms of the value that convergence brings, not just in terms of customer satisfaction, but also in terms of what it does to the market itself. So we're in the right geographies. We have broadly the right assets. And this is a big one for me, which is it took a while for me to appreciate what Deutsche Telekom and the T brand means in these economies. We have substantial, meaningful scale. So if you look at the size of our business in these countries, we are bigger than the sum of Vodafone, Liberty, Orange, and Telekom Austria. Broadly, the way these markets split up is we're about 1/3 of them. The 4 other international players are another 1/3. And then you have local players who are the last 1/3. And what's been happening with time is a lot of the local players have got consolidated, or you've seen erosion. And there is enormous power in the T brand in driving it across this footprint. Now, not just are we relevant from a narrow sort of telco perspective, but we're incredibly relevant to these economies and societies. And I'll come back and talk more about that. But we are almost 2% of the GDP of Croatia, 1.6% of the GDP of Greece. In a lot of these countries, we're not just the largest telco, we're the largest company, full stop. And our involvement in these societies and economies goes beyond traditional telco. In pretty much all our converged leader markets, we're either number 1 or number 2 as an ICT and system solution provider. Now, why is some of this relevant? Look, I spent a lot of time in Asia, and in Asia, we went through a phase where the penny sort of dropped to regulators, governments, and societies, that there was a huge opportunity for these countries to leapfrog by going straight into mobile internet and almost bypassing the desktop computer-based internet. and you saw societies as a whole, regulators, governments, get involved in driving that. I'm seeing a similar thing play out in the Central and Eastern European footprint. There is a real appreciation of the opportunities that digital and digitization can bring to these societies, and the opportunity to do a similar leapfrog using digital technologies. The reason our size and our system relevance matters is we can play a huge role in these societies and economies in enabling that to happen. And that would create a really positive environment, both in terms of how the society looks at us, but also in terms of how governments and regulators work with us in making this happen. Now, let's get to the slightly more depressing bit, right? So, a really strong asset, system relevant. Reality, you value us today at a 4.9 multiple. Now, in part, that might be due to country risk, but I suspect a large part of that is because of the left-hand side of this, where we've seen EBITDA decline by 3% and cash decline faster than that. And so while a lot of our peers are valued at 6.3 times, our sum of the parts is at 4.9. And that's, like I said, in part external factors, but also in part our performance. There are several things that have driven that performance, but before I dig into that, the good news is we now have real evidence that this is beginning to turn. Our revenues grew for the first time last year after a while, and that growth has continued into Q1 this year. Our EBITDA decline slowed down last year, and for the first time in a while, we saw year-on-year growth in our first quarter EBITDA. And these are the first signs, really, of what I believe is a sustainable inflection in the direction of this business, because it's not like we almost grew. We grew at a healthy 2.5% in overall terms. In organic terms, adjusted for FX, we grew by 1.6% in terms of EBITDA. Now, why did that happen? At the heart of it, our markets are back to growth, and that helps enormously. After years of decline, our mobile markets in the countries we operate are back to growth. The second half of 2017 saw a slightly dizzying 3% growth. Now, the reality is at least 1% of that is because of Roam Like at Home, because my countries are net receivers rather than net givers. And so Roam Like at Home worked well in terms of the top line. We still had an EBITDA hit because of costs, but in terms of growth, it certainly helped. But look, even underlying this, there's a healthy 1.5% to 2% growth that you can see now coming through in our mobile markets. Two fundamental drivers to it. One, the washout of the MTR-based cuts. Now, the MTR cuts actually had a deeper second-order effect beyond purely the loss of revenue. They also created instability in market pricing. Now, a lot of that has washed its way through the system. The vast majority of our interconnect cuts are done, and we're now at really low levels. That's driven some of the growth. I think the second bit is coming back to the story I was talking about on digitization. What you're seeing across our economies is a substantial growth in data usage, whether that's on the phone or whether that's on the fixed line. And what we're seeing is a strong appetite for increased data consumption, which shows up as revenue growth. So that's good news one, which is our markets are turning. Now, in a market that's begun growing, we have actually, over the last 3 quarters, outgrown that market as Deutsche Telekom. What's driven that? Fundamentally, a return to commercial momentum. Now, in the mobile business, the maths of it is pretty straightforward, where we have about 31% market share. Historically, our net add share was somewhere between 10 and 14%. That's back up at 29 to 30% now. We're getting our fair share of this market. And we're doing that without discounting or driving down price structures in this market. We're doing that by using our fundamental strengths, the quality of our network and convergence. And we'll come back and talk a bit about convergence, but we spend a minute talking about quality of our network. The fact that we're the best network in 9 out of 11 markets, now that's great news, but we've got to be able to monetize that. And that's really what we've started doing. What does monetize that mean? That means, firstly, increasingly a lot more of our advertising and what the brand stands for is going out and claiming the best network. We're not embarrassed about talking about it. Secondly, our own confidence and the mindset we've taken to things like pricing has been driven off, we are the quality leaders, therefore actually creating sustainable more for more. Now, I know more for more has often felt like a bit of a myth in this industry, but I'll give you the example of Hungary. We relaunched our entire tariff structure in Hungary in about August, September last year. Hungary, over Q4 and Q1, we're actually seeing greater than 5% service revenue growth, driven off a restructured portfolio, driven of our confidence in being the best network, and driving uptrade towards greater data consumption, which is riding the broader wave of societies that are data hungry in their vision of digitizing. So it's a combination of commercial momentum returning without, not at the expense of pricing, but riding the quality of our network, and really beginning to utilize our inherent strength in convergence. So we've seen almost an 80% growth in our consumer convergence revenue in the last year. We've seen about a 20% growth in our business convergence revenue. And here's where convergence really kicks in. We saw a 13% drop in churn. Now, when you pull all of that together, you've got a mobile business that's really beginning to motor now in the context of a market that is also beginning to grow. And it's motoring not at the expense of pricing, but driven by convergence and network quality. That's been a big engine of the growth. The second big thing that's kind of driven some of the turnaround is beginning to address our trouble spots. Historically, Poland, Romania, we had issues. Now, let me give you a bit of a story on where we are in those trouble spots. Look, when we have EBITDA trouble in a telco, and this is like kind of a bit teaching you guys to suck eggs, and I'm sure you're well aware of it, but the worst thing you can do is go out and try and solve the EBITDA problem. What you have to do is take a step back and make the fundamental investment in fixing the underlying problem. I mean, I've been in this industry 10 years now, but the story repeats, which is you start with fixing the experience. That results in higher NPS. That moves with time to greater employee satisfaction because the front line believes that they can sell your product. That, with time, converts into positive ports. With time, service revenue market share, and then EBITDA moves. Let me tell you the story of Poland. A year ago, our NPS was -12, which was number 4 out of 4 players. Our NPS right now is +12, and we are kind of close to number 2 in terms of our NPS. What has that resulted in? And a lot of that was driven by a big network claim on the back of actually having the best network in Poland, which we do, and the tests prove that. What has that resulted in? In the Christmas quarter 2016, we had 160,000 port outs and about 60,000 port ins. Christmas quarter 2017, we had 100,000 port outs and 145,000 port ins, right? So our port ins more than doubled, and our port outs fell by about 50%. What is all that converting into? Now, Poland's notoriously hard to look at service revenue numbers because of accounting. But when you look at the first quarter service revenue, we have gained anywhere between 0.5% to 1% market share year on year, depending on the way you look at the accounting. And Poland is on path to a turnaround, which has helped drive the stability and the growth in earnings. Romania, my sense of Romania is we're about 3 to 6 months behind where we are in Poland. But Romania is a fun market because we're in a similar place to where Mike was when he started the Un-carrier play. Now, a lot of the trouble in our Romanian business has been the erosion of the fixed line profit pool. Now, that's done or bottoming out. Our stakes in mobile are reasonably small. We're actually a small mobile player. And there's a massive profit pool that Orange and Vodafone are sitting on. We are going after that as an Un-carrier, right? And we're a converged Un-carrier, which is very, very compelling because we have a large fixed line network to cross-sell into, and we don't have the heritage of a large base on very high ARPUs that people like Orange and Vodafone have in Romania. And so Romania, Q4 last year, greater than 5% service revenue growth. Q1 this year, greater than 5% service revenue growth. So our troubled assets are on the mend. Are we done as yet? Are we seeing stable EBITDA and growing EBITDA? Not as yet, but that will come in 19. Because like I said, it takes a while to make these turnarounds happen. And Austria, where from our perspective, we preempted a directional move of a degrading market by going ahead with the UPC acquisition. Hopefully, we'll be able to complete that over the summer, but that would have preemptively addressed a potential area in our portfolio where we could have seen what happens in mobile-only markets, which is a steady degradation. So that's really been the heart of the revenue turnaround. On the cost side, again, we've seen a sharp inflection. So from 0.8% indirect cost reduction, we saw 2% cost reduction in 2017. What's driven this? I think a combination of two things. One, from a central or group perspective, really redefining our role to be much more like a private equity team. We see our role in the European HQ as being a small team of highly qualified experts who obviously monitor performance, but also exist to allocate resources, and probably most importantly, provide expertise to the countries. And expertise comes from having experienced people who've been there and done that. Convergence, big center of what we want to do and work with the countries on. We actually have now someone from the most advanced converged market in Europe, Portugal, Andre Almeida, who runs our convergence from the center. And therefore, when Andre sits down and has a conversation with the CEOs, it's not a theoretical conversation of, here's how you could do convergence. It's, I've been there, done that, here are my lessons, let's now drive this stronger. Similarly, on the app, we're rolling out one app across our entire footprint. The person who runs our app is the guy who used to run the app for me when I was at Airtel in India, who scaled the My Airtel app from 1 million active users to 25 to 30 million active users in 6 months. Again, Jonathan brings a certain credibility and experience, which, when you have a portfolio of 11 countries, is critical. Because the way you're going to drive the critical strategic initiatives is pick 2 or 3, get the world's best at doing those 2 or 3, and get them to work with the NatCos to make this happen, rather than have an army of project managers at the center. But that cultural shift has enabled us to substantially slim down our headquarter organization. At the country level, again, what we've seen, what we've been driving is a change in mindset. Historically, I've seen a bit of the manage the decline mindset, which is, let me explain to you through a compelling PowerPoint waterfall why the right answer is that we will decline. I think what we've seen happen over the last 18 to 24 months is a shift from that to saying, our job as the NatCos is great execution and a desire and hunger to grow. Now, that's been achieved in part through cultural change, in part through actually getting in a wholly new set of people into the countries, into the management teams. And a combination of all of that has created this environment of what we want to be and what we want to be famous about is delivering a great experience to our customers, driving growth in our countries, and becoming a smaller, leaner, more focused organization, which is why you've seen the inflection in costs. So that's some of the factors that have driven the green shoots of the turnaround in Europe. I'll now spend a few minutes talking about how do we build on this? How do we take this forward? So the heart of our strategy is completely consistent with the DT strategy across the group, which is leading in customer experience, especially through driving convergence, leading in technology across mobile and fixed, leading in business productivity and value transformation. I'll spend a few more minutes on this in detail. Let's start with convergence. Look, convergence, from an economic perspective, is a no-brainer. I totally agree with Mike, which is Customers don't care about whether it's fixed or mobile. They care about getting all of their services in a seamless manner from one place. The reality is in Europe, like Neville said, you don't have the fragmented broadband situation. You also have less spectrum than you do in the US, so fixed line will continue playing a big, significant part in convergence. But the economics of convergence are a no-brainer. Big churn reduction, substantial ARPU increase, and an increase in customer satisfaction. But what gets me excited about convergence is not the first-order economic effect. It's the second-order effect in terms of what it does to market structures. Let's take a look at this, right? I've somewhat been burnt by probably having worked in the two worst mobile-only markets in the world, UK and India. But for me, there is a joy to convergence, which is about creating private markets, which escape the volatility that open market mobile often has. So take the example of Slovakia. 48% of our gross ads, this is gross ads, it's even higher when you think of net ads. 48% of our gross ads now come from convergence, from selling mobile into our fixed base, which suddenly substantially reduces my exposure to volatility and drives greater stability into my business. Close to 20% of my Slovak mobile base is now converged. That's the base, that's not fresh ads. So when you look at convergence, for me, there's an obvious first-order economic benefit, but there's an even more compelling private market effect that convergence creates, which is why we want to really step on the gas on convergence. We would like to have greater than 50% of our households converged and over 1.7 billion euros in revenue from convergence in 2021. And the heart of doing it, a big part of doing it, is the go-to-market execution. And this is what we've learned in the last 18 months, which is why our convergence revenue has grown so much. A lot of this is about simplifying the customer offer, figuring out how you incentivize the front line, getting the right household data march so that you understand who has which product. And all of that will come together in the next 4 years to further accelerate this. Now, the real turbo boost for convergence, though, especially in our converged leaders, in my mind, will come from some of this ambition, but will really come from an aggressive fiber build-out. And I'll talk about that next. I talked about the ambition in these societies to become gigabit societies. When we look at our converged leaders, and that's really Greece, Hungary, Croatia, Slovakia, we have a unique opportunity to aggressively expand fiber. We want to move from 17% of our households passed in these markets with fiber to close to 30%. And that involves almost a tripling of our fiber rollout rate, and I'll come back and talk about that. But why do we believe in this? Because, one, there are unique economics to fiber in Europe. Two, there's a lot of societal and regulatory and government support for this. And three, we're in a unique position to do it. Let me talk through each of those. The economics of fiber. Now, in most of our markets, our ARPUs aren't that different from developed Western European markets. But the cost of fiber is, as long as you're going to between 25 and 50% of households and not going deep rural with it, is about 300 euros per home passed. Even in the case of a copper overbuild, I'm looking at 7 to 12 years payback on fiber, which is pretty compelling economics. And if you look at, is this all kind of slideware? You look at Slovakia, we're continuing to expand our fiber footprint, and our utilization of that, despite a substantial growth, you can see we went from 390,000 households to 490,000 households over 3 years. Our utilization is still staying in the high 20s. And that economics is very sound. It also creates the basis then for even more powerful convergence. From a societal perspective, there is a substantial demand in these countries to drive forward with gigabit societies, and there's substantial appetite to support us. Now, this does phenomenal things for us as a brand when we work with governments and societies to actually move them forward. Last but not least, couldn't anybody else do this? The answer is probably not, because laying fiber in these countries is operationally hugely intensive, takes a lot of experience and know-how to get it right. Also, we are uniquely advantaged in that we have mobile, so our economics are superior. All of which adds up to a compelling case for building out fiber across these countries. I'll go to the next bit, which is, so if convergence is at the center of our strategy, what about countries where we don't have our own network? Now, the way I think about convergence is I think there are two central factors that drive convergence. One is nationwide presence, because it's very hard to drive convergence if you're only present in one small pocket. And two is owner economics. Now, how do you get to those in these countries? Now, I think it is going to be country-specific, but a broad rule is we will get to nationwide coverage or have already gotten to nationwide coverage with good whole-buy deals. And then we add on top of that owner economics, either through M&A or FWA, FMS, and combine those two to create a compelling convergence proposition. Let's take the example of Austria, where we have a nationwide whole-buy deal. We also have a very strong FMS play, which will evolve into FWA as we move more into the 5G world. And then we top that off with an acquisition which helps give us owner economics. Czech, the answer is going to be slightly different. We actually have a really competitive whole-buy deal, thanks to the separation of Set-in and O2. We are actually market leaders in net adds in Q4 in Czech. As a mobile-only player with a whole-buy, we are the #1 net adds player in Q4 in Czech. We will support that with selective own build in the big cities of fiber, and that, along with potentially some opportunistic M&A of the smaller players, will give us the footprint that we want. Poland, this is the market where convergence is probably moving most slowly. And in this market, we have now a whole-buy deal, a letter of intent, which will convert into a proper deal over the next couple of months with Orange, which gives us access to the largest fiber footprint. We're in no hurry in this market because convergence isn't kind of taking off. The whole-buy deal gives me enough protection anyway. And then we look at opportunistic M&A. We already have a really substantial FMS business, especially in the rural areas, which again will evolve into FWA as we move more in the 5G direction. So that's the strategy for markets where we don't yet have a fixed line presence. Now, when you pull all of this together, what we're looking at is an increase in almost a tripling of our fiber rollout rate from 250,000 households a year to 750,000 households a year, with an increase in capital expenditure from about 92 million to close to 300 million, which is about a 200 million increase in capital expenditure. Now, I'll come back and talk about where we want to be is a flat CapEx envelope. So how do we fund this 200 million? Three big sources, and we're already proving out a lot of this. One, we think, one's the obvious kind of shift from vectoring, just fixed line money shifting from vectoring to FTTH. The second is mobile capacity optimization. Now, we've had a really, mobile capacity is one of those things where, if you add capacity on the average, you're almost always exactly wrong. Because typically, it's 5% of cells which account for 80% of your congestion. The question is, how well can you predict where you will see congestion? How well can you actually target your capacity in those areas? We've had some great experience in Hungary where we run the world's 4th best network. Last year, we continued to be the world's 4th best network after taking out between 30 to 50% of our investment in capacity, purely by using big data and advanced analytics to target where we added capacity. We see that again across our footprint as a place that'll help us fund fiber. And then there's the whole issue of our IT model, which again I'll spend a few minutes on, where today, or historically, a lot of our CapEx has been absorbed by large-scale BSS, OSS transformations. We are making a fundamental shift in that model towards a much more agile world, which will free up CapEx. Now, none of this am I including what we're seeing a lot of already, which is conversations with the government, because we're so central to digitizing these societies, on the use of EU subsidies. In several of the countries, we're in conversations with governments where we're seeing a lot of appetite for a tax to CapEx trade, which is we will reduce the levies on you as long as you give us euro for euro, the same money back in terms of investment in the country in capital expenditure. That collection of things is what makes me confident that we will see this expansion even in the context of a flat capex envelope. So that's a lot of the convergence story. Now, how do we pull all of this together beyond technology into a compelling customer experience? The heart of that, for me, is reinventing our IT, because at the heart of delivering our experience is a much more flexible, agile IT system. Historically, like I said, we've spent a lot of our time in the trenches, working through legacy systems. We have now moved to a new model. We are creating a digital overlay layer, which is something we call HAL, the homogenized API layer. That is now live across Croatia, Poland, Czech, Slovakia will go next month, Hungary will go after that. So across our footprints, even if we have different BSS and OSS systems, we will have a homogenized API layer, which then starts giving us the flexibility to create real service differentiation on top of it. Let me give you some examples of that. So the one app, which is built on top of the homogenized API layer, will fundamentally change our service experience and the way customers interact with us. Now, having lived through the whole Jio story in India, I'm compelled with what an app can do and what digital can do in terms of fundamentally changing the customer experience. Our ambition is to get to greater than 50% penetration of the app, if not higher. Just to give you a sense, in Greece, we're already at 40% penetration of the app, and we started 12 months ago, right? But it goes beyond the app. One of our ambitions as a converged player, and Mike talked about it, is customers don't care about fixed or mobile. They want to be connected everywhere. In my house, for example, I know the Wi-Fi is weak in some rooms, but the minute I go home, I'm on Wi-Fi, and actually, I get bad reception where my mobile network would be better. Now, all of us are used to the Starbucks experience where the Wi-Fi is quite often poor, right? But you switch on to it automatically. Now, wouldn't it be great if what your phone could do is automatically direct you towards the strongest network and latch on to that? Now, one of the things building flexible IT gives us is the ability to overlay on top of our products, as part of our app, seamless connectivity, the ability to always move to the best network. That's the stuff which we think, when we put on top of our assets, will give us meaningful service differentiation. Now, pulling that all together, right, which is we've got great assets, or a increasingly flexible IT, how do we then move that forward to total differentiation? Greece is probably our best example of this. We are the incumbent, but the number one on customer satisfaction on mobile, fixed, and TV. And that's because we've pulled all of this together with a strong, focused brand. And to Tim's point yesterday, it's not just about the digital. The only person anyone allows into their bedroom is our technician. They have to be incredibly well-trained. We have to invest in that, and we have to make sure this whole area of combining the digital with the human comes together. And Greece is kind of our benchmark on how we drive that, and that is something we will replicate across our countries. If I move forward into the B2B part of our business, our B2B position is pretty unique. In our small businesses, we are the largest player across both fixed and mobile. We have a huge opportunity now to convert that into cloud leadership. A lot of small businesses are hungry to go digital because they see the value, they see the saving. It makes a real difference to their lives. Instead of paying for a server, if I could have Office 365 hosted in the cloud, that means I have more money to spend on my business. We believe we will drive convergence in these markets, not just to fixed and mobile, but drive cloud on top of that. Already, 14% of our converged customers also have a cloud offering. We believe that number will scale substantially in our small businesses. In our larger businesses and public sector, where I talked about our strength in system solutions and ICT, there's a big opportunity for us to leverage that, not just into IoT, but also smart cities. Smart cities in Europe is not a concept or an idea. It's real. There's 2 billion euros of EU funding for smart city deployment, including IoT. In 2017, we actually generated 55 million euros of revenue from smart cities. And our ICT skills and our relationship with these large customers, as well as how central we are to e-government and digitizing societies, puts us in pole position to really drive this forward. I'll now move on to cost and how we continue on the journey we've been of driving down costs. Our target is to take out close to another 10%, 9% to be exact, of our indirect cost in the next 4 years. Now, in part, that will just be the good stuff that's already been happening in 2017 and 18, and pushing that forward will give us a headwind. But there's also 3 big pieces: simplification, digitization, and the right organization. Now, if I talk about simplification, Mike talked about it. We have got ourselves into an incredibly complex industry. We need to be ruthless about simplifying our tariffs, processes, and platforms. We're already making progress on this in Greece and Hungary. The numbers you see there are real estimates based on the work we've done in Greece and Hungary. We think we will take out between 60 to 80% of tariffs. We believe we will take out more than 50% of our process variations. And all of that will have a huge knock-on impact in terms of the level of customization of our IT systems. Digital, I've talked about this already, but driving digital hard and moving more and more of our touch points to the app. And the app is not just the app itself. It is almost the spearhead of simplification and creating a more agile, flexible IT stack, which then allows us to drive greater self-service and greater digitization of our processes, which is where we think the real savings lie in this. And last but not least, organization. Now, I've talked a bit about the mindset and why we saw an inflection in our cost savings. We will continue driving that by establishing the right organization between the center and the NatCos. There's also a large unexploited potential, which is our leverage in terms of size and scale. Now, this is not leverage in terms of size and scale in terms of producing products across countries. Claudia talked about that. We think the bang for buck there is actually cloudification, virtualization, and to a limited extent, cross-country product production. But we put Czech and Slovak together and ran it as one company. And we saw a huge saving, not from common production, but from common infrastructure, which is by reducing the number of servers, reducing the number of data centers, pulling together our infrastructure and leveraging our scale. And we think across organization and cross-border leverage, there is a significant opportunity for us to drive down our cost structure further. So if I pull a lot of that together, our commitment is Wachstum in Europe again. We will grow revenue by greater than 1%. We will see our EBITDA grow by between 1 to 2, cash grow by between 2 to 4, in the context of a broadly stable CapEx envelope. And to give you a little more flavor of this, in terms of the drivers, it's convergence, and therefore the size of our FMC revenue. It's digital and the app penetration. In B2B, it's exploiting our fundamental strength, all of which converts into profitable midterm growth, and hopefully you beginning to write about this as the prime cut rather than the rump of Europe. Thank you.